Hello everyone. In this video we're going to continue our discussion for chapter 2 about analyzing transactions, and in this last part we're going to go over the general ledger for the company, and we'll see what is the ledger and what are the how it looks like. So what we have here on this slide is the ledger where we have all the accounts for the business. So we can see here we have the cash ledger, or the cash account under the ledger, and you can see it has the account number on the top and its name, and then we have the date of all the transactions. In the post-reference column we see the journal, or the general journal pages. This is where all these transactions came from, and then the debit values and the credit values, and then we have the running balance. And we already said that accounts like cash, for example, they belong to assets, and assets, they increase on the debit side and decrease on the credit side, and their normal balance, their nature, is usually on the side where they increase, and that's why at the very end their balance has to be on the debit side. So the normal balance, or the nature of cash, which is an asset, is debit, and this is why the balance of the cash is always on the debit side. So let's see how it works. So for example, we started with 25 debit, 25,000. It was credited by 20,000, so that reduced the balance to 5. Then it was debited, or it increased by 7,500, so now it went up to 12,500, which is the 5,000 plus the 7,500, and that gave us the debit balance of 12,500. So we'll keep doing this. Like, credits would reduce the value, debits would increase the value, and we should expect that the cash, or an asset, would have a debit balance all the time. Then the same thing for accounts receivable. It's an asset. It has the account number here. We have also the date column, the post-reference, the debit and credit columns showing the transactions impacting the account, and then the balance. And you can see that since accounts receivable is an asset, it always had a debit balance. We also had supplies, which is another asset, prepaid insurance. All of these, they have ending debit balances. Land was another asset, office equipment, and that was the last asset that we had for this business. Then we had accounts payable, which is a liability account. It started with the number 2 here, 21 or 21, and then we have unearned rent. That's another liability account, 23. And these are the two liabilities that the business had. And you can see that their ending balances were in the credit side, because liabilities, they increase on the credit side. Their nature, or their normal balance, is on the credit side. Then we have common stock, which is a stockholder's equity, and this has a credit balance of 25,000. We have dividends. Dividends, remember, dividends starts with the letter D. It's a debit, and that's why it's always recorded on the debit side here. Then we have fees earned, which is a revenue, and revenues, they always have a credit balance. Wages expense, or supplies expense, rent expense, utilities expense, and miscellaneous expenses. All of these are expense accounts, and they always are on the debit side with their balances. So basically this was the ledger and how it looks, all these pages on it. The next stage in the accounting cycle, or in the process, is preparing what we call it the trial balance. And the trial balance is just a statement that shows a list of all the accounts in the business with their debit and credit sides. So errors may occur in posting the debits and credits from the journal to the ledger. One way to detect such errors is by preparing a trial balance. The double entry accounting requires that debits must always equal credits, and this is always obvious, and it's clear for everything that we've done in the past. For every journal entry, we always recorded something on the debit and something else on the credit. And because of that, we always expect that the total balances would be always, for the debit, should always equal to the credit. So the trial balance verifies this equality, that what we have on the debit matches what we have on the credit. So the steps for preparing the trial balance are as follows. First, we'll list the name of the company, the title of the trial balance, and the date the trial balance is prepared, which is usually a specific date. Then we'll list the accounts from the ledger and enter their debit or credit balances in the debit and credit column. So the trial balance is very simple. It has only 3 or 4 columns. One column for the account name, another column for the account number or the code, and then 2 columns, one for the debit and credit. And that's how simple it is. So we list the accounts from the ledger and enter their debits or credit balances in the debit or credit columns. Then we total the debit and credit columns off the trial balance. And then finally, we verify that the total for the debit column equals the total for the credit column. So here we have an example for the trial balance for NetSolutions, unadjusted trial balance. And we call it unadjusted because later on, we're going to see two forms of the trial balance. So we have the adjusted trial balance, and we have something called the post-closing trial balance. So the first one that we're going to get exposed to now is the unadjusted trial balance. And as you can see here, it has a specific date. It's not for the period, it's just one day, which is December 31st, year 3. We list our assets, liabilities, equity, and then the revenues and the expenses. And we have the account numbers here. We have the debit balances, the credit balances listed, and at the very end we should make sure that the debit balance should match the credit balance. Once they're matching, then we don't have any errors or mistakes, and that makes us ready to go to the next step, which is like making the adjusting entries, and then following that is preparing the financial statements. So what are the kind of errors that can affect the trial balance? We said the trial balance intention is to detect errors. So what are the errors that we can detect using the trial balance? If the trial balance totals are not equal, an error has occurred. In this case, the error must be found and corrected before we move on to the adjusting entries. We have one of those errors is called something called transposition. A transposition occurs when the order of the digits is copied incorrectly. For example, 542 would be recorded as 452 or 524. So we flip digits. If we change or miswrite the digits, then this can create an error. This can be easily detected because if the difference is divisible by 9, then usually it's a transposition. Another error that's known as the slide is whenever we add a 0 or we forget recording a 0. So the entire number is copied incorrectly, one or more spaces to the right or to the left, such as writing 542 as $54.20, or adding a 0 and it's going to be $5,420. There are errors that can exist on the trial balance, but we don't see it because they don't affect the trial balance. So an error may occur, and that doesn't cause the trial balance totals to be unequal. Such an error may be discovered when preparing the trial balance or may be indicated by an unusual account balance. So we notice that an account balance is inflated, like it's too large or too small. So in this case, we can identify that, oh, there's something wrong here. So if an error has already been journalized and posted to the ledger, a correction or a correcting journal entry is normally prepared. So let's see an example. Assume that on May 5th, 12,500 purchase of office equipment for cash was incorrectly journalized and posted as a debit to supplies and a credit to cash for 12,500. So remember, when we buy office equipment, that's an asset that has the title office equipment or simply equipment. Supplies are different. If we recorded this by mistake as supplies, then we have to correct that error later on. So the error was discovered at the end of the period on May 31st. So before making a correcting journal entry, the journal entry that was made in error is compared to the entry that should have been made. So we see what we've done, what we should have done, and the difference would be the correcting entry. So by comparing these two journal entries, the correcting journal entry can be determined. So let's see this in more details. So the journal entry that was made in error, we debited supplies for 12,500 and we credited cash for 12,500. The correct journal entry is debiting office equipment instead of supplies and crediting cash for 12,500. So you see, the problem is not with cash. Cash is recorded correctly on the credit side. The problem was that we debited supplies instead of debiting office equipment. So what we want to do is that we want to get rid of the supplies and instead we want to record office equipment. In accounting, we're not allowed to use an eraser and erase supplies and write office equipment instead. So what we're going to do is that since we by mistake recorded supplies, we want to get rid of it. So instead of having it on the debit, we credit it. So the correcting journal entry, we're crediting the supplies, and that's our way of erasing supplies, by recording it on the other side, on the opposite side. And now we want to bring office equipment instead, because we didn't record it at all. So we record office equipment on the debit side and we credit supplies. That's how we correct this mistake. And that we call it a correcting journal entry. So we debit office equipment for 12,500 and we credit supplies for 12,500, and we record just a brief memo saying to correct entry of May 5th, erroneously debiting supplies instead of office equipment. So this way we increase office equipment by 12,500 and we can decrease supplies by 12,500. In the last part of this chapter, we're just going to do some analysis for decision making, and today we're going to be talking about horizontal analysis. So what is horizontal analysis? A single item in a financial statement, such as net income, is often useful in interpreting the financial performance of a company. A comparison with prior periods often makes the financial statement even more useful. So just looking at a number, it gives us an idea. Let's say we are looking at the net income. Okay, that's a good number, but I want to see, is it getting better or worse? So in horizontal, we are going to see our number compared to prior periods, and that's, we can see whether there's a progress or not. So comparing net income of the current period with net income of the current period, comparing net income of the current period with the net income of the prior period or past periods will indicate whether the company operating performance has improved or deteriorated. In horizontal analysis, the amount of each item on a current financial statement is compared with the same item on an earlier statement. The increase or decrease in the amount of the item is computed together with the percent of increase or decrease. When two statements are being compared, the earlier statement is used as the base for computing the amount and the percent of change. So let's see an example. Here we have an example for this hypothetical company. It could be a real company, J. Holmes, attorney at law. And we have their income statement for year 7 versus year 6. And by the way, they usually present the most recent year first and then the previous year. And then we see the amount of change, which is the difference between these two values, and then the percentage change, which is how much is the amount compared to the base year. So, for example, fees earned, it used to be 150, now it went up to 187,500, and this is an amount of increase of 37,500. If you divide 37,500 by 150, that's 25%. So this is what we refer to as horizontal analysis. We're comparing 45 to 60. That's for wages. So you can see that wages went up by 15,000. How much is that? 15 out of the 45, that's 33%. So even though our revenues increased by 25, our wages went up by 33%. So something to pay attention to. Rent expense went up by 25%, which is similar to the amount of our revenue. Utilities expense went up more than the amount of fees earned. Our supplies expense actually went down. So it used to be 3,000, went down to 2,700 by $300. So that's about 10%. But it's a small amount. It's not that significant. And that's why at the very end you can see that our net income, even though our fees earned increased by 25%, our net income only increased by 19.9%. So I hope this presentation was helpful. I hope you can learn more about the recording transactions and analyzing transactions. I think the first 3 chapters or 4 chapters are very important, so please invest as much time as you can to make sure that you're solid on these concepts. Thank you, and I'll see you in the next chapter.